See, if you look at any individual's wealth, there is a certain portion of accidental wealth. It is inevitable. And there is a certain portion of accidental loss. That is also inevitable. That accidental wealth or accidental loss has to be an insignificant portion of his total wealth. If you think, or if you're under the impression, that you will have a substantial portion of accidental wealth, it's like similar to gambling or buying a lottery. You will also have a lot of accidental loss. Sometimes you are in luck, so you will have accidental wealth, but definitely that cannot be a very large proportion of your legacy. Planned returns is a function of asset allocation. No one knows which asset will perform better in which year or in next 5 years or 10 years. It's very difficult to estimate a defined return for an asset over a period of 5 years or 10 years. The best policy is always asset allocation. Allocate your assets across different countries, across different asset classes. At least you know that, okay, fine, I can make these kind of a defined or estimated returns over a period of time. And that also brings down your risk substantially. If one asset class doesn't perform good in 2-3 years, then obviously there would be other asset classes which would be performing better. So you average out on that. Investing is very cyclical. You can't predefine an expected return over a period of, let's say, 3 years or 5 years. There are so many variables which are there in the market which will impact your estimate of returns. Asset allocation works better. And every successful investor have purely made wealth on asset allocation. So India is purely a domestic consumption story. When you have such a big demographic advantage where the average age of people, which is around 28 to 30, obviously these people are gonna spend. That is when the start of the bull market always has been. If you look at US, their best period was when they had a fantastic demographic advantage. You call them as a baby boomers. They earned a lot and they spent a lot. Even now, US is one of the key markets for domestic consumption. That is why their equity markets have been consistently performing very well. And India's story is similar to what US has seen. We have such a large population which are at this age bracket, where important things are obviously discretionary consumption. It's not only for 10 years, it's there for at least for next 30 years plus. India has a lot to see in terms of per capita income. When you have that advantage also moving up, we've seen a per capita income, doubling, tripling in last 10 years. And when you see that same story play out for next 10 years, when per capita income is expected to double or triple in 10 years, you'll obviously see a lot more consumption going on in India. That gives a huge advantage. Typically most of the investors, or when you look at it, typically a lot of companies who want to set up in India, they are setting up in India to play the domestic consumption. They're not setting up in India to make it a manufacturing hub and then export it out of India or whatever. That is an incidental part of their business. So this is the biggest story of next 10 years, 20 years, 30 years of India. So obviously India will continue to do well. Definitely you will have a lot of volatility in India, because whenever a country is growing, it will have growth pangs. Volatility is actually the friend of the market. People will have more savings because there has been a tax break which has been given, and that more savings will translate into more consumption, and the more consumption will benefit the companies, and the companies will have their profitability going up over a period of time. And that's how the trend is. So, US companies, out of S&P 500, 39% of the companies typically earn around 16 to 18% ROE, EPS, whatever you call it. If you look at India, out of the Nifty 500 companies or BSE 500 companies, 34 companies. India is the second largest market in terms of percentage of companies earning a high double-digit kind of a ROE. That exactly is what has been playing out for last 15-20 years. Every budget there has been some kind of a reform process which has helped the Indian investors to make money, and will continue to be there. Every company, whether it is in US or Europe or anywhere in the world, they are very serious that there has to be a distribution of their manufacturing basis. So this is what is happening today in a multipolar world. And this is going to be there whether Trump is going to continue or a different government is going to come or whatever. So that advantage, India will also benefit. You will get some opportunities, you will lose on something. But if you start reacting on every bit of news flow, then panic will obviously be there. Volatility will always increase. And when volatility increase, that is when you have an opportunity. Yes and no, honestly. Taxation is not an important objective for moving your base from one country to another country. The most critical factor is a policy continuity. You can have a high taxation or a kind of a medium taxation, but if you have a good policy continuity, then it makes sense for a lot of these companies to move out of India or move out of US and set up in Middle East. Okay, or wealthy individuals to move their assets from India to offshore and everything. The opportunity is always there, but whether this opportunity will continue forever, that's a bigger question mark. End of the day, every country will need to tax its investors, the companies out there. Taxation is inevitable. What quantum is a question mark. You can argue that this quantum is higher in Canada, this quantum is higher in Europe, it's less in Middle East, it's less in Singapore. You can argue that. How long will the argument continue is a big question mark. See, it's a chicken and egg story. Okay. If you think that India provides the opportunity of 1.4 billion people domestic consumption, and you have different sectors which are doing very well, then India is a place to be. If you look at any stock market indices in different countries, and if you break down those indices into different sectors, many of these countries will have commodities or a real estate as the maximum contribution. The moment you come to markets like India, US, you will have so much of depth. There is not one sector which will be like 50% weightage or a 40% weightage. So that gives an immense advantage for any investors looking at these different markets. Okay. And specifically domestic consumption is what drives these different sectors to have supernormal growth. That's point number one. Point number two, when you look at taxation, let's take for example Middle East. Most of the Middle East governments have today realized that they need to diversify from oil. That is why many of them are promoting tourism, many of them are promoting a lot of initiatives to attract companies and everything. They have realized that, and they have also introduced corporate tax in some of these countries, personal taxes in some of these countries. When you want to move your legacy wealth to some other jurisdiction, and then if the rule changes after 5 years, 10 years, then you're caught in a limbo. So when you look at, whether it is a tech space or the innovation space, obviously US has been in the forefront of attracting talents because of their immigration policy and because of the depth of their market. And from an investor in India who wants to invest outside of India, there is a lot of capital controls. The most popular avenue which people generally use is the LRS, which is the Liberalized Remittance Scheme, where you can transfer $250,000 per person per annum. For larger family offices, there is another mechanism which is called as the ODI. That gives them the advantage of moving much higher sums per annum. That is what we also suggest to larger investors. Move your money if you want to invest outside of India, because end of the day asset allocation matters and you need to invest in different markets. Move your money via ODI. Invest across different markets. In today's context, US dollar is considered as the reserve currency for the world. So rupee always tend to depreciate vis-a-vis the inflation in US versus India. So if you look at the past for the longer term, it's typically around 2.5% to 2.7% over 20 years. That's been the depreciation trend. However, what happens is that it is not a linear 2.5% to 2.7% every year. It happens in a 5 years time frame in a bunch. When it gets bunched up, you suddenly notice that year rupee has depreciated by 10%, and then there is so much of media hype around that depreciation, so much of bad news, etc., etc. Most of the currencies have depreciated against US. If you look at Japanese yen, which has fallen by 50% in 2.5 years, Japan is considered as a developed market vis-a-vis an emerging market like India, then suddenly you think that, okay, are we better off than Japan? Are we better off than UK when you compare the depreciation? Yes or no? And for next 10 years, 15 years, there will be still that inflation differential between US and India. How does an investor understand this? That is an important element. Okay. When you look at a 20-year dollar return, which is inflation adjusted return, then you will find that India returns are equivalent to US. When you have a 5-year dollar return on the index, MSCI India, it is very much available on record. A 5-year return on index MSCI India is 12.5%, which is after accounting for the rupee depreciation. A 12.5% return on the index is pretty decent dollar return. When you extrapolate that to an actively managed fund, which has given at least a 2% bare minimum over the index, what more do you need as an investor? That advantage people don't realize. What protects you from inflation? And equities is the best bet. That is what many Indians have today realized. And that is why you see the domestic investor participation going up substantially. It is expected to go up much more substantially over the next decade or so. Just remember this fact also. India had a very high inflation 10 years back. It has now controlled its inflation, 4.5%, which is very good. That gives a lot of comfort when you look at it from a long term on the rupee side. And when you have these kind of extra returns over inflation, how do you create wealth? You make 2% over inflation, you automatically create wealth. You don't need to be greedy. You have the MSCI index, which has got all cap world index. What it denotes is that if you invest all across the globe, what kind of a returns you would have made in the last 10 years, 20 years. MSCI does intense research into different companies across the globe, and they have formulated a set of stocks which comprises the index. So if you look at that all cap world index, 10-year return is around 9% on dollar terms. This is purely on the index if you go with a proper advisor and then invest in select markets. You'll obviously have much better returns than the index returns. The most important thing is there should be no conflict of interest. An investor typically requires services on multiple parameters. Let's take, for example, a family office investor. He will require services on trust services. He will require services on asset allocation. He will require services on, so many other things which are part and parcel of the family office. The biggest advantage for 3Q is that 3Q sources across different firms for the best cost-effective solution to the investor. 3Q is not tied up to any single entity or any single fund houses or any single investment manager or any single trust services. There is no conflict of interest. That's the biggest advantage, I would say. And 3Q doesn't manufacture its own products. You can negotiate what is best for the investor, what is the most cost-effective and a qualitative solution which is acceptable to an investor. That, I think, is a major advantage as such. The other focus point should be the quality of people. Does the firm have enough qualified people? So if you look at, for example, CFA, which is one of the top-notch certificates in the finance industry, there are only around less than 200,000 people in the world. 3Q's got 2 members from them. 3Q has a member who've done FRM. And if you look at the experience of the people, it's all 20 years plus. And if you look at the service record, it's 10 years plus. When you have all these secret sauces for a successful firm, 3Q ticks all the boxes. Globally, real estate, if you look at it as an investment portfolio, the rental yield typically has been around 2 to 3%. Then you have the capital gains. If you look at long term in terms of real estate, the capital gains, they are inflation beating, but they are not equity beating. Coming back to my very earlier point, where asset allocation is the most important parameter, you should have real estate in your portfolio. But maintain that asset allocation depending on what kind of a risk you are willing to take. Let's say that we do a risk profile on you, and then the output comes as that you can hold 10% in real estate. You should hold 10% in real estate. That's the most important role of a financial advisor. If you think that, no, I want to chase returns, I want to hold 50% in real estate, I would say there is only one context. People who chase performance always underperform, because there is always some asset class which has performed better, and you will be greedy for that. So don't chase returns. You go to a doctor, you have a headache. You say that I've been having headache for last 10 days, it is not going. Your wife goes to a doctor, same doctor, and says that I have a pain in my leg, which is not going for 2-3 days. If the doctor prescribes a Panadol or a paracetamol to both the husband and wife, then obviously he's not a doctor. Similarly, you will have to go to a financial advisor. And if he shows you the basic stuff and says that this is an investment portfolio which is advised by my head office, and this is the past returns of these portfolio by any of these products, then that means he is not an investment advisor. There is no one size fits all kind of a financial product. Everybody needs to know and needs to do their complete risk profiling, not via an application. Has to be a physical thing, specifically from a family office perspective. And that is exactly what I do also. And when I do that, I know my asset allocation. I know different markets, and I invest according to that. My return expectation is not something like, okay, fine, a small cap fund has delivered 25% over last 10 years. I should put all my money into small cap funds. That is not my policy. If I generate 12% return, I double my money every 6 years. There's a difference between a profit and a wealth. Profit is temporary. Wealth is permanent. If you generate 12%, you double it 6 years. In 12 years, it is 4 times. 24 years, it is 8 times. 8 times is a decent amount of wealth.